Students, today we are starting group audits. Group audits. So we have to know what is group and how to audit it. Now, a group audit is the audit of group financial statements. We all know that we have been preparing console, we call it console, that is consolidated financial statements. And then that is what we call group. The parent company in conjunction with what? Subsidiaries and sub-subsidiaries that form the group. So a group audit is the audit of group financial statement. For this topic, you need to what? Be aware of the requirement of the following accounting standards. So meaning that once we are coming to do a group, it means you have to be conversant with the following standards. Now, International Financial Reporting Standard 3, which is business combination. International Financial Reporting Standard what? 10, consolidated financial what? Statement, where we say console. Then International Financial Reporting Standard 11, joint arrangements. And then International Standard Financial Reporting Standard 12, disclosure of interest in other entities. Then International Accounting Standard 27, revised, separate financial statements. And then finally, International Accounting Standard 28, investment in associates and joint ventures. These standards will help us to understand what group audit means or what it entails. And you are well conversant with these ones already. In addition, International Accounting Standard 24, related party disclosure is also of particular reference because companies within a group are related parties. So when you are doing group account or group audit, related parties are very important because they are related. Therefore, issues concerning related parties are very relevant. Now, group audits and the audit of what? Individual group companies. We have individual companies coming together to form what we call the group. And therefore, the individual firms are called components. They are called what? Components. The audit on the financial statement of the components of a group will follow normal auditing principles and practice. So when you are auditing, a group, it has our components. It's not different from auditing a single company. It's the same. The principles are the same. Everything is the same. But as far as this chapter is concerned, we are going to do additional audits. We are going to consider so many things in addition to the normal audit of what? A company. That is where the group comes in. Now, the organization and planning of a group audit is usually more complex, and it's true. It's more complex than the single company that we have been doing. So it means we need to do a detailed job for the following reasons. The following reasons will tell you that group audit is a bit difficult than the regular audit. Groups may include a large number of companies. Yes, not a single company. So many companies coming together. Some companies in the group may have a different year-end accounting. As we all know in group accounting, if the parent financial year ending is different from the components or the subsidiaries, there's a need for adjustments because all the accounts should come to a particular date. It will be necessary to make audit adjustments that are made to the financial state. So when you are auditing a group account, it means that those adjustments that are done to bring the component the subsidiaries in line with the parent company, you have to audit them. Those adjustments need to be audited. Some group companies may be audited by an audit firm that is not the auditor of the parent company. Yes, when they say group audit, it doesn't mean that if you are, let's assume, Deloitte and Touche is auditing, a particular group, it's not necessary that Deloitte and Touche should audit all the components. Some components will be audited by other audit firms. The group engagement team is the audit team responsible for the audit of the group financial statement. So there may be two teams or different teams. Those who are auditing the components may be the same company auditing the group. But in some cases, the group auditors or team may be different from those auditing the components. So that's why we are now going to learn these things, and it's very important. This can be seen in our SR 600. In fact, refers to the group audit, the group engagement partner, and the group engagement team. So we have group engagement partner, the partner responsible for that group audit. He is the engagement partner as far as that is. And the team that are working for him or for her, that is the engagement team for that group. They may be different from the component auditors. Sometimes they may be the same team that will audit the component, but in some instances, no. So the group engagement team will establish the overall group audit strategy. So whoever is doing the audit, the overall audit group, group audit strategy need to be established by the group team, or what you call the group auditor. Then you must communicate with component auditor. If you have different people auditing the components, there should be a good communication between the component auditors, and then perform work on the consolidation process. You must also perform work on how the consolidation was done and how the results were arrived at, and then evaluate the conclusions drawn from the audit evidence obtained in order to form an opinion on the group financial statement. This will enable the group partner be able to form opinion on the group financial statements. Now, component auditor, assuming we have a group auditor and a component auditor. A component auditor is an auditor who, at the request of the group engagement team, performs work on financial information related to a component for the group. So meaning that a component auditor is the one who audits the subsidiary or the components. And then the component itself is what? A component is an entity. It's a company on itself or on its own business activity for which group or component management prepares financial information that should be included in the group financial statements. Now, group audits preliminaries. The relationship between the group auditor and the component auditors. So if you have component auditors who are separate from the group auditor, it means that there should be a relationship. So we are saying information of components that are audited by other audit firms. That means other firms are auditing the component, whilst the group auditor and the team audits only the group financial statement. The group auditor is required to determine how the work of the component auditors will affect the audit of the group financial statements. Since the group auditor is the one going to give opinion on the financial statement that belongs to the group, it means component auditors, whatever work they are doing, it may have impact on the group auditor's opinion. The group engagement partner is responsible for, so meaning that is the group auditor who is responsible for direction, supervision, and performance of the group audit, and then issuing an appropriate group auditor's report. So he is responsible for direction, supervision, and performance of the group audit, and he also issue appropriate group auditor's reports. The group auditor is solely responsible for the auditor's report on the group financial statements. So whether somebody has done the component for you or not, you are solely responsible. The group auditor is solely responsible. Because of this sole responsibility, ISA 600 contains very specific guidelines. Because of this, you are solely responsible for the audit of the group. The group auditor is what? Responsible for the direction that the group auditor should give to the what? The group audits, and then the group auditors' involvement in the work of component auditors. Now, accepting an appointment as group auditor. Before you accept the appointment as a group auditor, the firm does this by obtaining an understanding of the group and its components and their environment sufficient to determine. So before you accept the job, it means you must understand the group structure and the component, its components and its environment. Then, and to determine which components are significant to the group, which groups are significant to the group, then which significant components are audited by others, and then whether as a group auditor the firm will be able to what sufficiently what involve in the audit of significant components to obtain sufficient appropriate audit what evidence about them. Significant components are those that are, when they say significant components in group auditing, they are components that are of individual significance, significant to the group. Individually, that's material in group context, or have been identified as likely include or significant risk of material misstatement of the group financial statements. So when it says significant components, they are individual significant to what? The group. Once, as far as the group is concerned, that component is so significant. Two, the risk of misstatement or the likelihood of what? Risk is in the financial statement as per that component is huge. That means have been identified as likely to include a sufficient risk of what? Material misstatement of the group financial. Because if the group, the component is materially what? Misstated, and the risk there is very high, it will affect the group. It will affect the group. Now, understanding the group. Now, as a group auditor, you need to understand the group, its components, and the component auditors. So these are the three areas you have to know. You have to understand the group you are going to audit, its components, those individual companies that come together to form the group, and what? The component auditors, those who are going to do the component auditing. Yes, you must understand all these things very well. In accordance with ISA 315, the group auditor must identify and assess the risks of material misstatement through obtaining an understanding of the entity and its environment. So meaning that as far as group audit is concerned, the group auditor must identify and assess the risks of material misstatement through what? Obtaining an understanding of the entity and its environments. This will mean that enhancing the understanding of the group, its components and their environment, obtained that's at this acceptance or continuation stage. So at the early stage, you should understand the what? The component very well. Then obtaining understanding of the consolidation process, the means by which they come to what? Prepare the financial statement. The way the financial statement is prepared, it's also you have to understand it. So obtaining understanding of the consolidating process, including what? Instructions issued by management to each components. Including what? Instructions issued by management to each component. And then, so if you have be able to obtain all these things, this will what? Enable the group auditor to confirm or revise its what? Initial assessment of components which are likely to be significant. Now, when the group auditor plans to request a component auditor to perform work on the financial information of a component, he must assess the following issues. So anytime you are a group auditor and you are giving the instruction for a component audit to the component auditor to audit the component for you, it means you must what? Assess the following issues. One, whether the company auditor understands and will comply with the ethical requirements that are relevant to the group audits. So you must now assess the what? The auditor, and find out whether the company auditor understands and will comply with the ethical requirements. Then the next one is the component auditor's professional competence. Yes, it means you have to find out whether the component auditor is competent or not. Whether the group engagement team will be able to be involved in the work of what? Component auditor to the extent necessary to obtain sufficient appropriate audit evidence. So what this means is that if there's a need to involve the group team members as far as the component audit is concerned, you need to plan it. Whether the component auditor operates in a regulatory environment that actively oversees what? Auditors. So where the component auditor works, the environment, what environment operates in that is the auditor operating in an environment which is what? Regulated by what? Actively and over regulated and actively what? Oversees auditors. If that is done, then it means you have to consider so many things there. And then let's go to materiality. When they say something is material, the group auditor will need to set group materiality for the financial statement as a whole. So you, the group auditor, you have to set what? The materiality for the group. Then the component materiality for those components where component auditor will perform an audit or review for the purposes of the group audit. So meaning that the group auditor is responsible for what? Trying to find the materiality as far as the group financial statement is concerned, and then also put what? Materiality down as far as what? The components are concerned. The component materiality will usually be lower than group materiality. We have component materiality and then group materiality. And they are saying that the group materiality is higher because it's all the components coming together. So you could see that the material aspect there is very huge. But that of what? That of component is lower because it's just maybe just be some small companies which form the group. Now, planning and controlling a group audit. Now, how do you plan the audit as far as what? Group is concerned? Planning and controlling a group audit. The principles and guidelines for planning and controlling a group audit are similar to those for the audit of an individual company. So there's no difference between what? Planning and controlling of what? Audit. Once it is how to plan the audit, how to control the audit, it's the same. Whether it's a group or it's a component, is the same. This additional consideration will require the group auditor to do the following. But there are some things that you need to do as a group auditor. You must familiarize himself with what? The client procedures for preparing group financial statements. So meaning that you must get involved, know more about how the financial statement will prepare for the group. And then you must ascertain the client's timetable for the preparation of the group financial statement. You must ascertain it, obtain it. And then establish an audit strategy and audit plan for the entire group, including what? The audit of company. So you must now come out with what? A strategy for the whole group and the components. Working with components auditors. Assuming you are working with component auditors who are different from the group auditors. Now, determining the type of work to be performed on components. Now, if components are working, the component auditors are doing their job. You may be facing some two problems: either to take part in the audit, or you leave them to do their job. And then now let's look at the procedure. Where a component is of individual financial significance to the group auditor or a component auditor must perform an audit using component materiality. So once you have so many components and you decide, or you have seen that that component is significance, and they told you that significance may be in the form of what, how riskier the component is, or how the value of that component is as compared to the whole group. So where a component is significant because of likely significant risk of material misstatement, the group auditor or a component auditor must perform one or more of the following. So either the group auditor performs or the component auditor performs it. One, an audit using component materiality. You audit the component using what? The component materiality. Then an audit of one or more account balances, classes of transactions or disclosures, depending on where the risk of material misstatement lies. Then specify audit procedures to address the risk of material misstatements. For non-significant components, components that are not significant, the group auditor should perform analytical procedures at a group level. So there you are not going to do a detailed audit, but you are going to do what? Analytical procedure. At that component, you will do analytical review of it and then add it to the what? The what do you call it? Overall group financial statement. Communication with component auditors. Already we were informed that the component auditors are the auditors who audit the components apart from the group auditors. So you need to have a rapport with the component auditors. So it is therefore vital that there is a clear and timely two-way communication between the group auditor and the component auditor. They say two-way. So two-way means that you give them instruction and then they also give you feedback, which is the report they give to you. So you give the instruction, do this, do that, and do that. And then they also write, when they finish the work, they give you a feedback by giving you their report and some other requirements that you ask them to be given to you. So that is the two-way they are talking about. The group auditor's requirements are usually communicated in a letter of what? Instruction. So the one that the group auditor gives to them is what we call letter of what? Instruction. Then the component auditor's communication with the group auditor will usually be in the form of what? A memorandum or report of work performed. The report of work that you have done, the component auditors have done. Then the group auditor's letter of instruction. Now let's go to the group auditor's letter of instruction to the component auditor. Should set out. So whenever you are giving instruction to the component auditors, those instructions should cover these areas. One, the work required. What do you want them to do? What you want them to do is what you must give to them as instruction. They used to be made of that work. What are you going to use that work for? So, and then the form and contents of the component auditors, communication with the group engagement team, and what you are expecting from them. That is the next one. So we have three there. The work you want them to do, they used to be made of that work, and then the form and content of the component auditors communication. It should also include what? A request for cooperation. You need to also, in your instruction, ask them or inform them to cooperate. And then they should follow ethical requirements. And then component materiality that you have carved for them, you need to communicate to them. And then identify the significant risks. If you have identified significant risks in the component, you need to communicate with them. And then a list of known related parties. If you know any related parties, then it is very important also to communicate to them. The component auditor's report of work performed should include, now that you have given the instruction, the component auditors, when they finish the work, or then they have to give you feedback. So they are saying the component auditor report of work performed should include. So the work they have done, the report that will give to you, back to you. is what you are talking about. A statement of compliance with ethical and group auditor requirements. So there should be a statement that they are complying with the ethical and what group requirements. The identification of the financial information on which the company auditor is reporting. So meaning that identification, which financial statement are you auditing? That one too should be in their what report. Then a list of uncorrected misstatements of the financial information of the company. Any uncorrected misstatements in the financial statement need to be communicated to you. The indicators of possible management bias. In case management is biased in one or two ways, these things should also be brought to your attention. Then any identified material weaknesses in internal control. So since we all audit and we are auditing the internal control system put in by management, if you have identified any weaknesses in internal control, you need to highlight it to the group auditor. Any other matters that may be relevant to the group audits. So as a component auditor, any information you think is relevant as far as the group is concerned, you can communicate that to the group auditor. And then the company auditors overall findings, conclusions, opinion. Yes, we normally write opinion at the end of our report. So what is your opinion? What is your final? That is the overall findings. Okay, are the financial statement prepared in accordance with so and so? Are they fair, true and fair? If not, you have to. Those things are some of the issues that the company auditor need to capture in his or her report to the group auditor. Then involvement of the group auditor in the work performed by component auditor. We were informed that at the beginning that once you are group auditor, you are faced with two things. Either you are going to involve yourself in the component auditor's job, or you only leave them to do their job. So now if, for example, you have decided to, let's say, involve yourself in the component auditor's job, then these are the following. For significant components, he must, as a minimum, if the component is a significant component, so as a minimum, these are the things that you need to, if you are going to involve yourself in the component auditor's job, you must first of all discuss with the component management or the component auditor the business activities of the company that are significant to the group. So these are they have to discuss with them. You must discuss with the company management or the company auditor. Then the next one is discuss with the component auditor the risk of material misstatement of the financial information of the company. If there is, you have identified any risk that you have identified, you need to be communicated. Then, or that means you have to discuss with them. Then you must review the company auditor's documentation of identified significant risk of material misstatement of the group financial statement. So you must review the work of the company auditors. And all those things can be reviewed through documentation. You have to go through their working papers and find out whether they have done the right thing. Now, where significant risk of material misstatement of the group financial statements have been identified at a component, the group auditor should, assuming that there is a significant risks of material misstatement at the group financial statement level, and then that thing has been identified at a component level, then the group auditor should evaluate the further audit procedures to be performed. Yes, to address such risks, you must evaluate whether there is a need for further work to be done or so. Then you must also consider whether it is necessary to be involved in those procedures, whether you yourself or your team need to be involved. But I want to say whether you, in this case, if the group auditor is involved, it doesn't mean that he himself will go to the field and work. It means his team. Then such involvement might include, if you want to involve yourself as far as the component is concerned, audit is concerned, Then the following, you must have meeting with what? Company management or auditors to obtain understanding of the component. You must also review the company auditors' overall audit strategy and plan. And then you must perform risk assessment procedures at the company level. So that is about group audits. Let's continue. Joint audits. What is joint? Two separate audit firms coming together to do an audit is called what? Joint audits. And you know, joint audits, they are from different audit firms. Let's say Deloitte and Touche and KPMG, they come together to audit one particular financial institution or its organization. So a joint audit involves two or more audit firms being appointed to audit the financial statement of an entity. Just a single entity, two audit firms coming together. The joint audit provides joint opinion on the financial statement of the company. If two audit firms are coming to audit, it means the two of them are jointly liable for anything that happened as far as that audit is concerned. So they must have what you call what do you call it? They say joint audit may occur in other. Sorry, joint audit provides a joint opinion on the financial statement of the company. So the opinion, true and fair or not true and fair, that opinion should be signed by the two audit firms, or if there are three, the three audit firms. Then joint audit may occur in other situations, but they are commonly found in group audit. Most of the time, it is group that you get so those things, but sometimes, so it happens on its own. Joint audit should not be confused with what? Shared what? Audits. Now, advantages of joint audit. You see, if two strong audit firms come together to audit, there are advantages. So let's look at the advantages. The client company may be so large that it requires the services of more than one firm of auditors. Yes, if the client is so huge, there's no way only one audit firm can complete it. So it is important to do a joint audit in that instance. After the acquisition of a large subsidiary, using joint auditors may help the transition process where the group auditors become familiar with the new subsidiary. Yes, that's it. A company, let's say a group, go in and buy another subsidiary. The subsidiary was formerly being audited by a group of people, or let's say audit firm. So that audit firm plus the group auditor can come together and becomes a joint audit. Joint auditors may provide a higher level of what? Technical expertise than either audit firm could provide individually. Yes, there are two giants. Let's say Deloitte and Touche and KPMG. They come to do joint audit. They are giants in their own field, and therefore they are going to pull together various expertise in that audit. It improved what? Improved geographical coverage may be what? Obtained for the audit, where each of the what? Joint auditors can on its own does not have offices that cover all the geographical locations of the companies in the group. It is also very important where location is concerned. Assuming Ghana, there is a company in Ghana that has subsidiaries all over the world. The audit firm may not be able to do all the work, so there may be what? Joint audit along the line. Another audit firm will be auditing some part, whilst the other one also audit the other side because of the geographical locations of the subsidiaries. Now, anything that has an advantage also has what? A disadvantage. So, disadvantages of joint audits. The first thing is it involves additional cost. So, extra cost to the clients. Yes, it is true. It is likely to cost more to use two accountancy firms than to use one. It is true. Therefore, it's very expensive and cost to the clients. Possible inconsistency between the two joint auditors in the audit methods that they use. Auditors use different methods, and so consistency in the what? The audit is at stake. Another one of the audit firm may be using risk-based, whilst other what do you call it, auditor may also be using what? System based. So it's a problem. The possible difficulty the two firms may have in agreeing the division of work. The work needs to be shared. So there will be a difficulty in sharing the work. Additional problem that will arise in monitoring and controlling the audit work of two different. Yes. Once they are two separate audit firms, it means that monitoring and controlling becomes difficult. Then two firms may find it difficult to work well together. And each firm may try to become the leading firm in the joint. Yes. Bosu, somebody say Bosu. So the two firms are giants. Deloitte is a giant, KPMG is a giant. Now, if they come together to who is the boss? That is the problem. Costs may be higher due to involvement of multiple audit firms. Costs may be higher. Yes, it may be higher because of the joint audit. Now, how do we do the joint audit? Performing joint audits. The key to a successful joint audit is good communication between the firms, including joint planning meetings and regular discussions between the firms. So a good and successful, what do you call it, joint audit can be done if they do the planning together and they do regular discussions at all stages of the audit. The meetings and discussions should be fully documented. Whatever has been discussed or agreed upon need to be what? Documented. So performing joint audit need what? Joint planning and then regular discussions, which is fully documented. So audit firms performing joint audits will have a number of factors to consider, including the following. Each audit firm will need to consider if the other firm is independent and competent as they will be providing a joint audit. So audit firms performing joint audit, these are the things they have to assess one another and see whether you are what? Independent and you are competent. Then the two audit firms will need to agree on joint audit strategy. Yes, there are so many strategies that auditors apply. So they have to agree whether we should use risk-based, system-based, and so forth and so forth. The joint auditors will need to agree how to coordinate their work. Yes, coordination is very necessary. It's equal the same as what? Monitoring. So they have how to coordinate the work. This may be difficult if each firm follows different methodology. So they are telling you that is a problem. If you are using a different methodology and this one is also using it is a problem. Then we also have, ideally, there will be no duplication of work as this increases cost for the audit clients. Okay, now we come to the auditing the consolidation process. You know, financial statement has been consolidated, so you need to audit it. Now, roles of the group auditor with regard to what? Consolidation. As far as the group auditor is concerned, what role does it perform? There's a role of the group auditor with regard to what? Consolidation. ISA 600 requires the group auditor to obtain an understanding of the consolidation process, including the instructions issued by management to its components. So your group auditor, that is your job. The group auditor will want to confirm that the following actions have been taken correctly by this client group. 1. There has been a full and accurate transfer of information from the individual financial statement, the component financial statement, to the final consolidated financial statements. That correct information are carried from the component financial statement to the group financial statements. Make sure those things are done and the appropriate consolidation adjustments have been made. If there is a need for adjustment, those adjustments have been done properly. Now, the main audit procedure relating to consolidation are as follows. Clerical accuracy. Make sure there is what? The figures are accurate. Then, status of what? Investments. It means you must confirm that the parent company has correctly classified investment as a subsidiary, associate, or joint venture, or simply investment in accordance with what? Standard accounting practice. These are some of the things you need to do. Then, changes in the group. If there is any change in the group, these things need to be properly accounted for. And let's look at this. For acquisitions, confirm fair values, the calculation of purchase goodwill, and accounting treatment in accordance with what? International Financial Reporting Standard what? 3. Then, where there has been an acquisition during the year involving deferred consolidation as part payments, check that the amount of deferred consolidation has been included in the cost of what? Acquisition at discounted present value using a current pre-tax cost of capital as the discount rate. So you see, the accounting that we all know, the console that we have been saying, is the same thing they are repeating here. Okay, so you must look at those things very well. Consolidation adjustment. If you come to adjustments, what are the things that you need to look at? Reconcile the intercompany transactions and balances. Reconciliation should be done so that company transactions are properly reconciled. Then confirm intercompany balances and check whether the balances that they brought forward to the financial statement of the group are correct. Check calculations of the adjustment for unrealized profit. In case some transfer has been done and the goods have not been sold, there's no need for what? Profit to be on it. So you need those adjustments need to be done, checked. Then check the calculations and disclosure of non-controlling interest, and then check the accounting treatment of intercompany dividends and other what? Dividends. Loss-making investment. There are some investments that are loss-making. Consider whether any goodwill on acquisition has suffered an impairment. So if there is an acquisition and that acquisition there is an impairment in it, that may excuse me. Consider whether a write-down of the investment in the books of the parent company is needed. If a subsidiary makes losses consistently, its going concern status may be in question. So check for all this. Loss-making, that means loss-making investment. Then related parties. We were informed that a group is different kinds of what? Companies coming together. So there's a related party issue there. Ensure the provision of International Accounting Standard 24 are complied with. Thus, most components of the group will be what? Related to most other. You see, International Accounting Standard 24 talk about what? Related parties. So in a group, related party issues will crop in. Then reporting. Each conclusion about whether the group financial statement present a true and fair view, and then what? The principle relating to group audit report are dealt with. That's where we come to the later chapter. Okay? Subsequent events. Subsequent events. Yes, there are some events that may only come to light after the financial statements have been prepared. So in that instance, they are called subsequent events. The subsequent event review will need to include what? Procedures to identify events at components what? That occur between the date of the component financial information and the date of the group audit report. So the financial statement for the component may be prepared earlier, and then there may be a difference between the time that component financial statement has been prepared and the preparation of the group financial statement. Something may happen, so it's a subsequent event. So you need to look at those things and make it. These procedures will be carried out by the group auditor or by the company auditors. Those issues that may happen from the time of the preparation of the financial statement for the component and the end of what? preparation of the financial statement for the group, these issues may come out, and they are saying that either the group auditor or the company auditors should what follow the following procedures: documentation and communication with what management, and those charged with what governance. As a group auditor, you need to what document, and then you need to document and communicate with management and the board of directors, who those charged with what governance. Now, in addition to meeting the requirement of international accounting international standard for auditing 230 audit documentation, the group auditor must also document the following matters. So there are some important issues that you need to do. You need to document an analysis of components, identify significant components. So there should be analysis of the company and their what? Their status, significant components and insignificant components. Then the extent of the group auditor's involvement in the work performed. How you want to involve yourself in the component auditor's job, you need to document it. And then there should be written communication between the group auditor and the company auditors concerning the group auditor's requirements. Then the group communication is group management, which is different. The other one is board of directors, or which you call what? Those charged with governance. But this one is what? Management. The group auditor should make group management aware on a timely basis of the following. So, as far as management is concerned, the group auditor must let them know the following: material weaknesses in the design and operating efficiency of the group wide controls. You let them know the operating efficiency. Then you must also let them know material weaknesses which are significant to the group that the group auditor has identified at company level. Anything that you have seen at the company level which will affect the group, you let them know. Material weaknesses which are significant to the group that company auditors have identified at components and have brought to the attention. Yes, the company auditors may come out with some findings. Any weaknesses they have identified, let them know, let the management know. Any fraud or suspected fraud identified by the group or component auditors, you must also let them know any fraud or what identify. ISA 600 requires the group auditor to communicate the following matters to those charged with the governance of the group. Governance of the group is different from governance of what? The components. So that's the governance of the group. That's the group management, and that's top management plus board of directors. And then the one that is the component, that one is the type of work to be performed on the financial information of components. So as far as the component is concerned, the work you are going to do, then the group auditors plan involvement in the work to be performed by the component. How you plan to involve yourself in the component audit, you need to let them know. Any concerns over the quality of any component auditors, yes, if you think that the company auditor is not all that credible or there is a problem, you have to let them know. Any limitation on the group audits, yes, all what we discussed above, any limitation that it will put on the group audit, let them know. For example, lack of access to information. Yes, if they didn't give you access to information, how can you conclude? Then any fraud or suspected fraud involving group management, component management, or employee with significant roles in group side wide controls, where the group resulted in what? The fraud resulted in what? Material misstatement. So let them know all these things. Thank you very much.